Hello everybody, and 2.0 rule has been broken for the first time in about 10 years for the S&P 500. What do I mean by that? Let me explain which 2.0 rule am I talking about actually. It's not difficult to explain. So on the screen you can see these Fibonacci lines and these rainbow color levels. You can see the measurement of all strong corrections for the S&P 500 over the past 10 years. Okay? Let's take, for instance, a COVID as an example. So I basically measured the COVID strong correction, and then I projected extensions of that correction into the other side. So what it actually means that the COVID was a 35.5% correction, and when it actually recovered and when we went into the new all-time highs, the 35.5% is right here on this yellow line. That's the 2.0 level. Okay, so basically the whole correction this way, and then it recovered and it made into the new all-time high the very same amount. That's this yellow line. And then like that, we have this yellow line, which is the projection of 2022 strong correction, and then we have the yellow line that is a projection of 2025 strong correction. As you can see, 2011 strong correction is missing, and the reason for that is because we've already corrected strong even before we hit this 2.0 line, okay? Because COVID came sooner. And the rule goes like this. So every time when we cross this 2.0 level, we basically kind of went into a stall and then had another strong correction. That happened in 2022. That happened in 2025. The level here was actually hit with such a precision that it allowed me and others to call very, very, very correctly and accurately this stock in February 2025. You can also scroll back on my X to see my posts from that time. And then of course I measured the 2025 strong correction, and the 2.0 level stood at 7,446. As you can see, the moment we crossed that level, we started stalling, and I did think that there is going to be very likely at least any correction, at least 10% correction. But no. That did not happen, to my big surprise. And also, on top of that, you should acknowledge the seasonality. Let me show you. So as you can see, this is the seasonality for the S&P 500. This is the past 20 years. So I've even extended the sample that I'm measuring. And as you can see, there is only one negative month during the year that is on average negative, and that is September. On average, S&P drops down by 0.45%, but you can also see that August is actually very, very questionable month, because S&P goes up on average only 0.1%. Okay, so August, it's not supposed to happen this, what just happened. This is going against the seasonal patterns, the seasonal data. And I'm not even speaking about the what usually happens on midterm years, because we have a midterm year in 2026. I'm not even mentioning what usually happens during those years. I've already talked about it many times before. So there were many, many arguments against this to happen, and yet it still did. So there were signs maybe, now when I'm looking back, when I'm trying to take a lesson from what happened, there were signs that right here, basically every influencer that I follow was bearish, and his audience as well. So there were signs, and also the same here, but right here I was bullish, because I identified that there is going to be only 5% correction, which was exactly the 5%. But right here, it wasn't the case. So there were some signs, and there is a lesson to be taken for me again. However, what's next? What do I see next for the S&P 500. So let me talk about that, and maybe let me delete, oh no, let's leave maybe these lines here. So I would very simply, because the simplicity is usually the best approach, so I would, with all the simplicity, just watch for another Fibonacci ratio extension of the 2025 correction. Okay, and that ratio is 2.618, because when you have the Fibonacci number sequence, let me show you what I mean. This is the well-known Fibonacci number sequence, and basically when you compare the ratio between these numbers, so let's say 144/89 or divided by 89, you get 1.618. When you divide 1.44 by the two numbers in that sequence, but two numbers ago, so by 55, so 144 divided by 55, you get this another one, 2.618. Why do I believe that this one is going to work since the 2.0 didn't work? Well, first of all, when we hit the 2.0, there is an obvious something, okay? The market did try to turn around, right? You can see it. It was parabolic, and it tried to turn around the moment it hit the 2.0 line. But the 1.618, which is the previous 2.0, is not a Fibonacci ratio. 1.618 is, and the moment the market hit 1.618, which was 6,951, the moment the market hit that, it couldn't rise anymore, and it then waited for a couple of weeks for a good story, which was the Iran war, and then it corrected 10%, well, 9.7% was it, correction? Let's check here. Yeah, 9.79%. So this is an argument to be made that this was a 10% correction in March 2026, and it happened off 1.618. So that's why, hence my arguments why 2.618. And let me make a line here for all of us to see, and let me make that line on a different color. Let's maybe match this level color. So this level and this level is 8,245. That's what I believe that is the most likely where we are going, where we are heading. Also, when you look at the previous strong corrections and some further extensions, extensions that are further away, well, actually there we're talking 9,000 S&P 500. That's a little bit still too far. But I would say that the 8,245 is going to be a level where we will either stop again and go sideways at the very least, or at the very least correct like 5% or 8% or so. But it could also be the level where we're going to turn around also, because we really have not seen the markets have been just very, very strong ever since the 2025 lows. So this is the level I will be looking at. And when you zoom in, let me zoom in a little bit. So when you zoom in, you actually realize, or I've realized, that we actually came almost halfway. We've already pumped, in the matter of 1 week, we've pumped 6.5% for the S&P. And from that top, if we make another if we make a 6.5% from where we are at the moment, then it would be it. Now, if you've watched my update that I've done with a successful investor, Curtis, we've done that about a month ago. If you watch that, I'm making quite a few cases that the top for the S&P is going to be around when the last of the giant IPOs will roll. And the last is supposed to be the OpenAI, and it's supposed to be in Q1 2027. So I think there is a long time, actually many months before that happens, and we are already so high. So in my opinion, what this means, and connecting that to what I've just showed you a moment ago about a seasonality. August is not really a good month, and September is straight up bad month. So the chances that the markets are going to be weak somewhere in these 2 months are there. Historically, factually, are here. We have the Japan, funny things happening with yen. People call it an unwinding of the carry trade. So that could also correct the market. So I can see reasons for continuous volatility. Bottom line, I do not think, not at all, and I'm not betting on that either. We are not gonna go straight into the line that I've just projected, but I think that much more likely we are going to be very volatile and have a very volatile swings, kind of a sharp rejection, sharp recovery, and again and again and again and again, and stuff like that. So I do still see the volatility this quarter coming. However, I do admit that the past week was a shocker to me. I did not see coming that one.